Good morning, students. Let us again resume the topic of mergers and acquisitions, and let us start from the question number 18. AB Limited is planning to acquire and absorb the running business of XY Limited. Now, in this question, they are saying that AB Limited is planning to acquire and absorb XY Limited. The valuation is to be based on the recommendation of merchant bankers, and the consideration is to be discharged in the form of equity shares to be issued by AB Limited. So in the opening para itself, they are clarifying 2-3 things. One is that the valuation is to be based on recommendation of merchant bankers, and most importantly, the discharge will happen through the form of equity shares, the new equity shares which will be issued by the AB Limited. So that means all the concepts of acquisition through shares should apply here. As on 31st of March 2006, the paid up capital of AB Limited consists of 80 lakhs shares of rupees 10 each. So that is some additional information that they're giving. The highest and the lowest market quotation during the last 6 months were 570 and 430 rupees. For the purpose of exchange, the price per share is to be reckoned as the average of the highest and the lowest market price during the last 6 months as on 31st of March 2006. So see students, here the question itself has clarified that what is the purpose of giving last 6 months highest and the lowest number. They are saying that for the purpose of exchange, that means for the purpose of AB Limited issuing the shares to XY Limited on this acquisition, they will take the average of highest and lowest for the last 6 months. Okay, let us go further. Now, in the second part, they are saying that XY Limited's balance sheet as on 31st of March 2006 is as follows. So they say that, don't forget, XY Limited is the target company, correct? Because that is being acquired. So for that, they have two sets of shares, two classes of shares, 20 lakhs equity shares of rupees 10 each fully paid up, correct? And another 10 lakh equity shares of rupees 10 each. The class is same, but it is rupees 5 paid up. So that means it is 50. Okay. Then they have a loans. Then they have the details on the fixed assets. Now, an independent firm of merchant bankers engaged for the negotiation have produced the estimates of cash flows from the business of XY Limited. So they are saying that what are the going forward cash flows from the business of XYZ Limited is what they have given. And along with that, they have also given us the terminal value. So if you see, these are all the future projections, 2007, 8, 9, 10, and 11. So they have given us the future projections, and they have also given us the terminal value. I hope this terminal value term is clear, because in the previous session as well, we have solved one question on terminal value. So terminal value is after this, what is the present value of the future cash flows that can be expected on 31st of March 2011, growing on a constant rate and doing the capitalization also on a constant rate. Okay. Now, it is a recommendation of the merchant banker that the business of XY Limited may be valued on the basis of average of. So they are saying you have to take the average of aggregate of the discounted cash flow at 8%. Okay. And the second method they're saying is the NAV, which is the net assets value. And for the purpose of doing the discounted cash flows at 8%, they have given us the discount rates as well. Present value factors for 8% for years are as follows. Now, what are the requirements? This number one question is asking us to calculate the total value of the business of XY Limited. First of all, they're asking us to calculate the total value of the business of XY Limited. Now, let's start with the valuation itself, because in the first and the foremost part, we have to do the valuation of XY Limited. So we will adopt both the methods, because we have been given the data of two methods. One is the discounted cash flow and one is the NAV. Valuation of XY Limited using discounted cash flow method. So first of all, we are going to write year. So it starts from 2007, 31st March 07, 31st March 08, 31st March 2009, 31st March 2010, 31st March 2011, and another date I will write for the terminal value on 2011 itself, 31st of March 2011. Okay. So these are the years, and then what is the cash flows that are already estimated and given to us? Okay, the cash flows that are already estimated is 105. This is in rupees lakhs. Rupees lakhs. Okay, so 105, 120, 125, 120, 100, and 200. So these are the different cash flows. Along with this, the terminal value also we have mentioned. In the bracket I'm mentioning here, it as terminal value. Then we have to put the factors here, the present value factors, PV factors. Those are also given in the question. So for the first year, we can read it from left to right as first to fifth year, correct? Because 0.93 is for the first year, 0.86 is for the second year, and so on. 0.68 is for the fifth year, correct? Because that's how it is presented in the question. 0.93, 0.86, 0.79, 0.74, 0.68, and again for the last year, again we will take the same because it is the value as on 31st of March 2011. So we are going to take the same value here. Okay, students, now just a simple multiplication of, let's say, this A and B column. So we will write A into B here. That is just a simple multiplication that we'll have to do. So 105 into 0.93, 97.65. Then 120 multiplied by 0.86, 103.2, 125 multiplied by 0.79, 98.75, 120 multiplied by 0.74, 88.8, 100 multiplied by 0.68, 68, 200 multiplied by 0.68 again, 136. Means the total here comes out to be 592.40. This is basis cash flows discounting. This is the value coming out to be. So 592.40 lakh rupees is the valuation as per the discounted cash flow method for XY Limited. Basis these numbers given in the question. Now, so this is the first method that we have adopted, correct? But the second method, which the question is again saying us to calculate, is based on the net assets value, because they are saying it has to be the average. So the net assets value is very simple because we are completely given the total assets and the total liabilities, we can easily calculate the net assets. So now this was, let's say, the A part that we have used. In B part, using net assets method, net assets value method to correct it. Now, if we see the total assets, what is the book value of the total assets that is given to us? So it is 150 for the fixed assets net, and net current assets in totality they have given us 350. So 350, again, this would be in rupees lakhs only. Rupees lakhs. Total assets 350 less. What are the liabilities? Only liabilities, loans. There is 100 lakh rupees of loan. Correct? So loan 100, which will get reduced, and hence 250 becomes the net assets value for XYZ Limited in rupees lakhs. Now, what are the merchant bankers saying? They are saying that the average of both of them would be the right value for XY Limited. So they are saying don't go solely with the cash flow method, or don't go solely with the net assets value method. They are saying take average of both of them, which will take into account both the current book values as well as the future projections on the cash flows that they are going to get. So the average value will be 592.40 plus 250, this whole divided by 2. This is going to be the average value. 421.20 rupees lakhs. Hence, we can say that the value of XY Limited is rupees 421.20 lakhs. Students, please do ask as many questions as it comes to your mind. Okay, so value of XY Limited is 421.20. That is the first part of the question. Now, what is the second part is saying? This is done. The second part is saying the number of shares. Now, it is asking for the number of shares to be issued by AB Limited. Okay, so they are asking about the number of shares to be issued by AB Limited. Now, students, if we see what is the current valuation. Okay. So if we read out the opening paragraph again, okay. So what we say is that AB Limited is planning to acquire XY Limited. Now we are just trying to identify that which method is to be adopted here, whether it is exchange ratio, what kind of exchange ratio, or what exactly we have to use here. So if we read the opening para again, so they said the XY Limited is the target company and AB Limited is the acquiring company. They are saying for the purpose of this acquisition or merger, the valuation is to be based on the recommendation of merchant bankers, which we have already calculated. Valuation of whom? Valuation of XY Limited. So this valuation here, they are talking about XY Limited. Once it is valued, then whatever the value comes out to be as per the recommendation of merchant bankers, that is going to be the total consideration to be discharged. Correct? Because they are going to pay equivalent to the valuation of the company. Whatever is the valuation, that will become their consideration. Now that consideration has to be discharged in the form of equity shares. Correct? So that consideration will be discharged in the form of equity shares. And for that only, they are saying that for the purpose of exchange, the price per share is to be reckoned as the average. So just to cut the long story short, in the second part, total consideration payable is going to be 421.20 lakhs, correct? And the average AB Limited's share price is equal to 470 plus 530, which is the highest and the lowest quote for the last 6 months divided by 2. I hope these are the numbers. No, sorry, 570 and 430. Sorry, I put it wrong. It is 570 and 430. Which comes out to 500 rupees per share. Now, students, if you see 421.20 lakhs worth of consideration has to be settled by rupees 500 each share. That means how many shares are required to be issued is what the question is asking us to calculate. So the number of shares to be issued by AB Limited is equal to 421.20 lakhs divided by 500. So this comes as 84,240. Number of shares. Okay, Naveen, thank you. So 421.20 lakhs divided by 500 comes as 84,240 number of shares. This is 0. These are the number of shares to be issued in order to settle the merger or acquisition. Now, let's go to the last part. So the second part is also complete. Let's go to the last part. The basis of allocation of the shares amongst the shareholders of XY Limited. Now, students, again, if you see what we have discussed earlier is AB Limited and XY Limited. If AB Limited is going to acquire XY Limited, this you can find in the previous class discussion notes as well. If AB Limited is planning to acquire XY Limited and it is planning to settle the consideration through shares, so then it is going to issue shares to whom? It is going to issue the shares to the shareholders of XY Limited, not to the XY Limited itself. Shareholders of XY Limited will get the shares of AB Limited, correct? So XY Limited will not get, and hence is what it is mentioned, the basis of allocation of the shares among the shareholders of XY Limited. Now there are two different types of shareholders. One is that group which is fully paid, and one is that group which is partially paid. Now, students, please note here, we cannot split the consideration or the number of shares by 30 lakhs and split it 20 lakhs in the first section and 10 lakhs in the second section. No, we cannot do that. Why? Because the second group of shareholders have only contributed 5 rupees per share. Correct? So we have to see in terms of the total value that they are holding. Otherwise, the shareholders who have paid already 10 rupees will have a disadvantage, correct? So the third part, basis of allocation amongst shareholders of XY Limited. Now, can we say that there are two types? One is 20 lakhs multiplied by 10 fully paid up, and 10 lakhs multiplied by 5 fully paid up. Correct? These are the two classes, or not classes even. These are not the classes, right to say, because both of them are 10 each only. So these are the two, I can say, categories. Value. Value, if we see, it comes as 200 here and 50 here. Correct? So if we distribute a proportion here, so similarly, simply 200 by 250 is equal to 80%. So roughly 80% of the holding is held by these shareholders, and the balance 20% is held by these shareholders. Correct? Although in terms of the number of shares, the second one is having almost 50% of the first one, but still at an overall level, they are holding only 20%. So the allocation will be like this. Allocation will also be in 80-20 only. Correct? For the first category of shareholders, it will be 80% of 84,240. 84,240 multiplied by 80%. Similarly, 84,240 multiplied by 20%. Okay. So this comes as 67,392 shares, 67,392 shares. And this comes as 16,848 as number of shares. So the total becomes 84 to 40. Again, the same number. So that is how it will get allocated. Not basis the number of shares, because the paid up capital is different. And that is the only catch in this question. And this question is a very good question because it blends both mergers and acquisitions and valuation concepts, because we have to do valuation also here, and then we will have to do the mergers and acquisition related workings. I'm just writing it properly. 84 to 40. Okay, students. So this is our 18th question. Now let us go to our next question. Question number 19. Again, a very interesting and a very good question. So BA Limited and DA Limited, both the companies operate in the same industry. First of all, students, see, after these questions, we are going to cover the theoretical part as well. So it clearly says that both of them are operating in the same industry. If both of them are operating in the same industry, that means there will be some chance of either BA Limited taking over DA Limited or DA Limited taking over BA Limited, correct? In the mergers and acquisitions context. And then they give us the financial statements of both the companies for the current financial year are as follows. They are saying for the current financial year, apart from the balance sheet, they also have given us this time the income statement. Okay. So the balance sheet is also given in the old traditional format, correct? And the income statement is also given. Now, assume that both the companies are in the process of negotiating a merger through an exchange of equity shares. So they are going to exchange the equity shares. That means whosoever is the target company, their shareholders will be issued the equity shares of the acquiring company. You have been asked to assist in establishing equitable exchange terms and are required to. Okay. So they're asking us to play a mediator role by establishing equitable exchange terms, and hence they're asking us to do these things. Okay. So one is decompose the share price of both the companies into EPS and PE components. So first of all, they are saying that decompose the share price into EPS and PE, which is nothing but the PE ratio formula itself, which we have studied, and also segregate their EPS figures into the ROE and book value intrinsic per share components. See, students, this is actually a very interesting. So we will go step by step. We will read each part and then we will solve it. Okay. What I'm trying to say is that the market price actually, they are saying here the market price is a function of two things. Okay. One is EPS and second one is the PE ratio. So EPS will tell you that how much per share earning is the company able to do. P ratio will tell you the multiple that has to be multiplied in the EPS to arrive at the market price. What is the multiple currently on the earnings that is applied to arrive at the valuation, which is the market price. Correct? Then EPS again is broken down into two things. One is the return on equity, ROE, multiplied by the capital employed, or we can say the book value. As the question is using that word, I am also following the same book value and return on equity. So let's say it is 10% and it is some X value. So the EPS will become X multiplied by 10%. Correct? And hence the P ratio is, let's say, 17 times. So its market price will become 17 into X into 10%. So that is how they're trying to analyze it. How the market price is derived, what factor is leading to what things. So Siddharth is asking, it should not be in the ratio of 20:10, and later on make a final call, as we are giving disadvantage to the partially paid shareholders. So Siddharth, actually, if you see in the previous question, correct, in which we said that what is the right basis of allocation. If we say we are doing 20:10, correct, then these shareholders who have already paid ₹10 fully paid are in a disadvantageous situation. Why? Because they have contributed higher capital for the same number of shares compared to what the second type of shareholders have done. So if you ignore the ₹5 fully paid up concept here, then it will be a issue to the earlier ones. Okay. Because the current valuation split up is between 10:5, whatever is the contribution is. Okay. Yes. So now coming back to this question, first of all, we'll have to see what is the market price. Market price is 40 and 15. That is already given to us. Correct. Now, for this, we have to first calculate some of the basic things, because we have to see the book value, because we have to see the ROE, EPS, P ratio, and market price. So let us see that all these information is in one place. B Limited, DA Limited. We will start with earnings after tax. So if we see the income statement, so the income statement is already telling us that what is the earnings after tax for BA and DA Limited. 2,10,000 and 99,000. Can we also say that what are the number of shares? Because let us first complete the first part. So the number of shares are 1,00,000 and 80,000. Okay. How we have derived the number of shares? These are straight away given in the question. 1,00,000 and 80,000. Number of equity shares is 1,00,000 and 80,000. Correct. So both the numbers we have put in here. I will stay on to this page only now. I request all of you to open the question side by side. Then EPS, we can simply calculate as 210 divided by 1,00,000. 2,10,000 divided by 1,00,000 is 2.10 is the EPS here, and 99,000 divided by 80,000. So it becomes 1.2375. This is simply the earnings per share that we have got. Now the market price is given. Students here, please note, the question is asking us to just analyze. The market price is already given. That means we have to calculate the P ratio, correct? So let's first note down the market price. It is 40 and 15. These are the market prices for BA and DA Limited, and the P ratio will be market price divided by EPS. 40 divided by 2.10. Similarly, 15 divided by 1.2375 for BA and DA Limited respectively. So here it comes as 19.05 and here it comes as 12.12. So this is what the PE ratio is coming out to be. Now students, just to analyze between BA Limited and DA Limited, if you note one thing, BA Limited is having higher EPS and higher PE ratio, and hence the market price is also higher. It is 40 rupees compared to the 15 rupees here. That is because BA Limited is having higher earning potential, higher earning capacity, or higher actual earnings in the form of higher EPS, and they are also perceived from the market point of view to be traded on a higher multiple ratio, which is the PE ratio, correct? So the industry or the market perceives them that whatever they earn should be multiplied with 19.05 to arrive at their current valuation. Correct? So that means the multiple currently is very high. This is what the analysis is between both of them. Now coming to the book value as well as to the ROE now. So before calculating the ROE, because we know the EPS, if we come to know that what is the book value per share, we can simply arrive at ROE, correct? So the equity value is how much? Yes. If you see in this, there are two ways to calculate the book value. One is that if we take the assets minus liabilities approach, which is 24 lakhs minus this 5 and 7 lakhs, correct? Which is the liabilities, or simply we take the summation of these two. Whichever way it's okay. So the book value will be 12 lakh and 8 lakh. These are the book values. Equity value slash book value is 12 lakh and 8 lakhs. And hence the book value per share. Book value per share is how much? 12 lakh divided by the number of shares. Divided by 1 lakh. I think 1 lakh were the number of shares in BA Limited, if I'm not wrong. Yes. And in this case, it will be 8 lakhs divided by 80,000. So that means here it becomes as 12 rupees. I'm putting it here, 12 rupees. And here it becomes as 10 rupees. Both of them in per share basis. Correct? So the book value of both of them, BA Limited and DA Limited, is 12 and 10 respectively. And hence the ROE, which is the return on equity, will be EPS divided by book value. Okay, let me do one thing. Let me write this formula in the general data. ROE, I'm writing it here. Either we can do EPS divided by book value per share, or we can say earnings after tax divided by total book value. If we are taking EPS, which is per share, then we can take book value per share. Or if we are taking total earnings, we can take the total book value. So it is 2,10,000 divided by 12 lakhs. Similarly, here it will be 99,000 divided by 8 lakhs. This is the formula, and hence in terms of percentage, it will be represented as 17.5% and 12.37 percentage. So the return on equity for BA Limited is 17.5%. And the return on equity for the other company, which is DA Limited, is 12.37%. Now, students, if you see why there is a higher EPS, if we see why there is a higher EPS of BA Limited compared to DA Limited, because number one, the first factor is they have a higher book value per share, correct, compared to the book value of DA Limited. Second is they also enjoy a higher ROE. That means their return percentage is also higher, which makes the absolute EPS to be even higher of the BA Limited, correct? Because they are earning in terms of percentage higher compared to the DA Limited, and their price per share is also higher than the DA Limited. So which makes them high, having a higher EPS company. Okay, students. So I think the first part of the question is over. Now let us go to the second part. Estimate future EPS growth rates for each of the company. Now, students, if we see what are the other informations that are given in the question, because we skipped that earlier, but ideally we should go through the question once. So it is also given us to that dividend payment ratio is 40% and 60%. That means, students, if you see, I'm just trying to explain the another part here. For example, these are your total earnings. This box means this is your total earnings. Okay. Now within these earnings, you will distribute some dividend. For example, this much you distribute as dividend. And this much. So I'm saying this is A and this is B. So B you have already distributed as dividend. For example, that is 40%. Whatever is the balance 60% of your total earnings that you reinvest in your business. For higher growth. Now, students, we are going to take a very good conclusion from here. I think all of you agree that whatever total earnings we have, out of that, some of it will go as a dividend, and some of it the business would want to reinvest into the business. The business means the management of the business would want to reinvest into the business itself, so that along with the dividend, they're also increasing the market value of the share. Because if they don't invest in the business, how come the profitability will get improved, correct? So don't you feel that whatever they are investing into the business, that will give them the additional growth? See, students, currently this is, let's say, our capital, correct? And after this 60% investment, the capital will jump and will become like this, correct? So this is the revised capital. This is that 60% jump that has happened because of the reinvestment of this earnings. Once it happens, the revised capital will also increase and then it will continue. So if we were earning X amount here and Y amount here, definitely all of you will agree we will earn higher amount because of the higher investment in the capital in the form of retained earnings. What is the growth called here? The growth is we have reached from X to Y. Definitely I am saying that Y is the higher value here. Y is a higher value. So that is called as the growth. Correct? That is called as the growth. Why? Because growth is something additional you will get from the current returns. That is what is called as growth. Correct? I'm just explaining the literal meaning here. Growth is something that you are getting additional from the current returns. And technically, if you see how the growth will come, how the growth will be calculated. So we are saying that we have invested this 60%. Okay, this 60% gets invested, and what is the return on equity that is getting generated? Don't you think that this will be your growth? Whatever additional amount you invested, which is 60%, on that, whatever you are able to earn, which is ROE, the factor, the product of them will be equivalent to growth. Very easy and very simple, correct? Hence, can I rewrite this formula as growth is equal to retention ratio multiplied by ROE? Simple. Where retention ratio, I will explain. Retention ratio is nothing but how much we are able to retain out of the total earnings. So it is 1 minus dividend payout ratio. Simple. Let's say we are paying how much dividend here? 40%, right? So 1 minus 40% is equal to 60%. Simple. So always your retention ratio and dividend payout ratio will be equal to 100% or 1. That is called as retention ratio. Sorry. So this is called as future growth rate. Simple. We have understood from the layman's point of view as well as the technical point of view. Whatever extra you are investing in your business, on that you are getting a ROE return. If you multiply that, that is what the growth is, because growth is something extra that you are getting from the current numbers. Correct? So have we been given the retention ratio in the question? No, we have only been given the dividend payout ratio, which is 40% and 60% respectively. Now, second part, calculation of growth rates. Again, two companies, BA Limited and DA Limited. Correct? So, dividend payout ratio is given in the question. This is given as 40% and 60%. Okay. Using this, we can calculate what is the retention ratio, how much is what we are able to retain and reinvest into the business. That is 60% and 40%. Simple. Correct? So 60 plus 40 is equal to 1. Similarly, for DA, 40 plus 60 is also equal to 1. And the ROE is what we have earlier calculated in the previous part, which is where? Yes, 17.5 and 12.37 percentage. 17.35 multiply, sorry, 17.5 it is. 17.5 percentage and 12.37 percentage. Correct? So that means the growth, if this is A and this is B, so A multiplied by B is equal to 60% multiplied by 17.5% means 10.5 percentage and 4.95 percentage. Again, students, if you compare both BA and DA Limited, BA Limited is having a higher future expected growth compared to DA Limited. Why? Because of the simple reason, they are first of all investing more into the business than distribution of the profits. Second factor is their return on equity is also higher. So it is better for them to invest more into the business compared to the dividend payout. Okay, students. That is where it is going to help the overall valuation of the companies and hence to the equity shareholders as well. So this is okay. Growth rate is done. Now let us go to the next part. Based on the expected operating synergies, BA Limited estimates that the intrinsic value of DA's equity share would be 20 per share on its liquidation. Now see, here the calculation it is being done. So BA Limited is estimating that the intrinsic value or the book value of DA Limited will be 20 rupees per share on its acquisition. You're required to develop a range of justifiable equity share exchange ratios. Correct? So they are saying you need to develop a range. What is the highest ratio and what is the lowest ratio? Basis some of the matters discussed here. That can be offered by BA Limited to the shareholders of DA Limited. So they are asking us to calculate a range. This is the lowest, let's say, and this is the highest. This will be offered by BA Limited to the shareholders of the DA Limited. And they're saying, based on your analysis in part 1 and part 2, would you expect the negotiated terms to be the closer to the upper or to the lower exchange ratio limits, and why? So students, if you see in this, the exchange ratio is not a rocket science to do, because there are two. See, as of now, we have studied that we can find out the exchange ratios basis on certain things. Correct. See, whatever is given to us straightforwardly in the question, we will make use of that and calculate the exchange ratios. Now, let me go to the third part. Now, students, if you see in the third part, they are asking us to develop two ranges. Correct. Now, think from the BA Limited standpoint. Correct. Let's say you are part of the BA Limited, which is the acquiring company. Now, what does BA Limited has already analyzed? BA Limited has already analyzed that the current market price of BA Limited is 40 rupees, correct? And there are two things. One is the intrinsic value that has been estimated is how much? 20 rupees. And the market price is already given as 15 rupees. So students, if you see, BA Limited sees some higher value. So what BA Limited is thinking? BA Limited is thinking that the DA Limited is actually underpriced in market. If we talk about market, because market is only reflecting 15 rupees. However, as per my calculation, as per the BA Limited's calculation, the intrinsic value is coming out to be 20 rupees. That means the share is underpriced. And don't you think that to take over DA Limited, it would be okay for the BA Limited to go up to 20 rupees from 15 rupees? The minimum quote that BA Limited will give to DA Limited will be definitely based on 15 by 40, which is the market price based. $15 by 40, which is equal to 0.375 okay per share. I mean per one share. Let us rewrite this as is to 1. This is the first swap ratio, and intrinsic value based 20 by 40, which is 0.5 is to 1. This is the lower limit. And this is the upper limit. So students, if you see, the market price of DA Limited is 15 rupees, and hence with the current market price of DA Limited, they are ready to give 0.3751, so 0.375 is to 1 as the lower limit. And similarly, the intrinsic value based is 0.5 is to 1, which will act as the upper limit. And now they're asking us that which part it will be closer, whether the negotiation will be closed within the lower limit, I mean near or closer to the lower limit, or near or closer to the upper limit. Definitely, we have seen till now in all the comparisons, ROE, EPS, okay, PE ratio, market price per share, all the other things, even the last part that we calculate, the future growth rate also, for that matter, correct? Everywhere we have seen that BA Limited, which is the acquiring company, have an upper hand. Since they have an upper hand, hence it is expected to be closed on the lower limit. We can mention that since DA have higher EPS slash return on equity slash PE ratio, all of these things are higher, slash EPS growth rate, comma, the negotiable terms would be expected to be closer to lower limit. Okay. I think this is understood, because since BA Limited is a strong company, is having good financials, that will definitely make sure that all these things will bring it closer to the lower limits, the negotiable terms. Now, coming back to the question. Now, the next point, calculate the post-merger EPS. Now, they are saying that the merger has happened, and you have to do the post-merger analysis by calculating the post-merger EPS based on an exchange ratio of 0.4 is to 1. So, they are saying that finally, you assume the exchange ratio is 0.4 is to 1, which is somewhere lying in between 0.375 is to 1 to 0.5 is to 1, correct? And this is offered by BA Limited and indicate the immediate EPS accretion or dilution, if any, that will occur to the each group of the shareholders. So they are saying that you first calculate, you have already calculated the standalone EPSs for BA Limited and DA Limited. Now you do the merger and you calculate the post-merger EPS to see what is the impact, what is the effect, whether it is accruing or whether it is diluting. This is the fourth part now, correct? So the post-merger EPS and its, sorry, and its effects. This is BA Limited, DA Limited, and this is combined. First of all, we'll have to see that what is their earnings. Earnings after tax, 2,10,000 here, 99,000 here, 3,09,000 here, correct? The total earnings. Shares outstanding. BA Limited is simply, we will write the current shares. Now, how many shares will be issued to the DA Limited? What is their current shares? Okay, so what, let us do one thing. In the combined, we will mention the number of shares. Here, let us put the same number of shares, which is 80,000. Now here, it will be 1 lakh plus 80,000 multiplied by 0.40. That will give us the number of shares in the combined entity, which is 80,000 into 0.4 plus 1 lakh. So this becomes as 1,32,000. Okay, students. So this is the total shares outstanding. So standalone DA Limited is this much, DA Limited is this much, and combined is this much. So the EPS is 2.1, 1.2375, and 2.341. Now we can say that the EPS accretion slash dilution will be calculated how? It's very simple for DA Limited because the ratio is 1:1. For for DA Limited because the ratio is 1:1. For DA Limited, I'm saying, correct? So here it will be 2.341 minus 2.1. That means is equal to 0.241 is the accretion, is the increase in the EPS. And here it will be 1.2375 minus 2.341 multiplied by 0.40. So in this, we will compare the swap ratio adjusted EPS with the original EPS of DA Limited that we have already studied in our conceptual formulas. 0.301, which is the dilution. Correct, students? Because we cannot compare directly this 1.2375 with 2.341. Why? Because 1.2375 is for one share and 2.341 is for actually higher number of shares. Hence, we have multiplied it with the swap ratio to arrive at the comparable numbers. Okay, students. The next part is, now they are saying that fourth part is done. Now coming to the fifth part. Based on a 0.4:1 exchange ratio. Again, they are saying assume the same exchange ratio and assuming that BA Limited's pre-merger PE ratio. BA Limited's pre-merger PE ratio will continue after the merger. Correct? Estimate the post-merger market price. So they are saying assume the PE ratio to be the same, calculate the post-merger market price and show the accretion or dilution in the pre-merger market prices of both the companies. Again, a very simple conceptual thing that we did in the last part. Last part was on EPS. This is now on MPS. So for BA Limited, let me write it a bit here. This is BA Limited. This is DA Limited. And this is the combined entity. Now EPS is what? We have already calculated 2.10, 1.2375, and for the combined entities was 2.341 because they are saying that the exchange ratio is same. So from the last part itself, we have taken the combined EPS 2.341. Then the PE ratio is also we have worked out in the previous part 19.05, 12.12, and for the combined, it is 19.05. This is the given in the question. Simple. This is already given in the question. Hence, we have followed that. The market price. Sorry. It is also given as 40, 15. And here it will be multiplied EPS into PE ratio, which is 44.6. Now, the accretion slash dilution will be calculated how? 44.6 minus 40, which is 4.6 rupees accretion. Then 44.6 minus, not 44.6, multiplied by 0.40 also, correct? Because we will have to adjust it for the swap ratio, minus 15. 2.84. This is actually dilution. No, this is also increase only actually. This is also accretion. Both of them are increasing because the overall value has increased. Hence, for the shareholders of DA Limited also the proportionate increase has happened. And in the previous case, it was decrease only, I hope so. 2.341 multiplied by 0.40 minus 1.2375. Yes, it was a decrease only for them. I hope this question is clear to all of you. This is a very good question because it revised almost all the concepts that we have studied. Okay, students? Yeah, let us go to the next. And this is a very unique question number 20, because it is from the bank's standpoint. Okay, so we'll discuss this question and then we'll see what are the unique points in this question that needs to be understood. So it says that during the audit of weak bank, so there is a weak bank for which the audit is going on, RBI has suggested that the bank either should merge. Yes, during the audit of the weak bank, RBI has suggested that the bank should either merge with another bank or may close down. So they are saying that weak bank, there is no future. Either it should merge or it should close down. Strong bank has submitted a proposal of merger of weak bank with itself. Now they are saying that strong bank has come up and it is asking that, okay, I will do the merger of weak bank with me. The relevant information and the balance sheet of the both the companies are as under. Correct? So they have given us some KPIs or some of the important metrics that are used in the banking industry. For example, gross NPA. Gross NPA is what is gross NPA? Let us discuss these ratios once. So the gross NPA is actually gross NPA because this is given in percentage, right? So this is gross NPA divided by the total advances. By advances, whatever I mean that whatever loan that the bank has given, on that, how much of them has went NPA, that is given by this ratio called gross NPA percentage. Now, for example, if you go to the balance sheet of this bank and see that these are the advances given, 3,500, 27,000. Are there any other advances that are given? No, that's all. Don't search for advances in the liability side because we are talking from the bank's balance sheet point of view. The bank's balance sheet, whatever loan they give, that will come under the asset side, correct? Hence, this is the advances on which there is a 40% and 5% NPA sitting. NPA means that there is a non-performing asset that is sitting there, correct? Then, second is the capital adequacy ratio. Now, what does this capital adequacy ratio means? Capital adequacy ratio means that for one risky asset, how much, for 1 rupee of risky asset, how much capital does the bank hold? See, because if you see, I mean, from the banking industry point of view, each and every asset have a risk weight. What is the risk weight of that asset? Some of the assets have a more than 100% of the risk weight also. Some of them have a 200% kind of a risk weight as well. Some of them have a 0%, 10%, 20, 30, 40, similarly 100% as well. So the risk weight here means that what is the percentage of amount of the that asset that will go as unrecoverable. Correct? That is called as risk weight. But it is expressed as a ratio. So capital adequacy ratio is, what does exactly this mean is total capital divided by the risk weighted assets. The students, the question is also clarified here. They have also given the meaning. Capital adequacy ratio, here it means total capital divided by the risk weighted assets, risk weight assets, correct? Then simply normal term is given, market price per share, which is regular. Book value is also given, and the trading on stock exchange, they have mentioned that it is irregular and frequent. So weak bank, definitely very less people will trade. Strong bank, it will be traded regularly, correct? Also, they are saying that there are weights that are given to each of these. Gross NPA, there is a weight. Capital adequacy, there is a weight. Market price per share and book value, they have given a weight for which the total is 100. Correct? So they would want us to do the calculation, the exchange ratio basis these metrics. Let us see what it is. Then they have given us the balance sheet of weak bank as well as the strong bank. Both the banks, they have given balance sheet. In their balance sheet, they have equity share capital, they have liabilities, they have a lot of assets. And what they're asking us to calculate swap ratio based on the above weights. So first of all, students, they're asking us to calculate the swap ratio basis these four metrics. Now, first part, calculation of now, students, don't restrict yourself that swap ratio can only be calculated using these three things: EPS, MPS, book value per share. Till now, we have studied only these three methods, right, for calculating the swap ratio. But in this question, if you see, there are two more things. One is the capital adequacy ratio. One is the gross NPA. There are two more things. Now, students, here comes the change element. So, all these ratios, EPS, MPS, book value per share, higher it is, better it is. Hence, what we do in the numerator, we always put the target company's number, and in denominator, we always put the acquiring company's number, with the simple logic that if EPS is higher of target company, I'm saying EPS is higher of target company, it will make the entire swap ratio also to be higher. That means the acquiring company is willing to give more shares for the target company's one share, correct? Because the ratio will be higher. If the EPS is lower of the target company, automatically the swap ratio will also be lower. I hope this relationship is understood. If we are putting anything of target company in the numerator, that means the swap ratio has a direct relationship with that number going up or down, which is the right thing to look, because EPS is a ratio which higher it is, better it is. Similarly, MPS is also a financial indicator, higher it is, better it is. Similarly, book value per share, higher it is, better it is. Capital adequacy ratio, is it higher, better, or lower, better? It says that for one risky asset, for rupee 1 of risky asset, how much capital you hold. If you hold 2 rupees of capital, which is A, or if you hold 3 rupees of capital, which one do you think is better? Definitely 3 rupees of capital is better. That means the exposure is less. That means the bank is self-sufficient. Bank is holding a lot of capital to cover up for the risky assets. That means CAR also, higher it is, better it is. Lower it is, worse it is. Correct? It will not be better, it will be worse. It will not be good. So if you say that I am an acquiring company, and on that table, in the other side of the table, there is some target company that is sitting, and if I see that the target company's CAR, capital adequacy ratio, is better, I am willing to pay him more. Why? Because they have a good capital profile. They have less risky assets, good capital, and hence I am willing to pay them more. Hence, the formula of swap ratio becomes as capital adequacy ratio of target company divided by CAR of acquiring company. Now, think it from the gross NPA standpoint. Now, what does gross NPA means? I hope NPA, all of you are aware, is non-performing asset. Non-performing asset means those assets where the interest and principal repayments are not coming over a stipulated period of time. That means there is a gross NPA. If there is a gross NPA, that means, is it a good thing or a bad thing for a banking business to have? Now, again, I am an acquiring company. On my front, there is a target company that is sitting. It is having a higher gross NPA. That means in its books, the non-performing assets percentage is very high. If it is very high, do you think that I am willing to give them more? No, I will give them less in terms of the exchange ratio. Why? Because I will say that already that company is into a trouble. Hence, I would want some kind of a discount while I'm purchasing that company or while I'm deciding on the exchange ratio. Hence, if we put the gross NPA of target company in numerator, that will create a problem, because that will mean that higher the gross NPA, higher the swap ratio will be, which is not the conceptual case. The conceptual case, higher the gross NPA, lesser should be the swap ratio. Hence, I will tweak the formula like this. Gross NPA of acquiring company. Simple. So in case of bad ratios, or in case where there is an inverse relationship between those ratios and the valuation, we will swap the numerator and denominator. Because this percentage will make sure that if gross NPA of the target company is higher, I am giving them a lower exchange ratio only. I am not giving them higher exchange ratio. Simple. Only this was the point. And one more point in this, which will come. So this was one of the unique point that we have to discuss. Now, if we see the gross NPA, now it is proved from the facts that are given in the question also. If you see the gross NPA is 40, if you say the gross NPA is only 5. If we go by the same logic, let's say we do gross NPA of weak bank divided by gross NPA of the strong bank. So it will be 8:1. Do you think that strong bank will give 8 shares of its own for 1 share of the weak bank only because there is a gross NPA of weak bank higher than the strong bank? Don't you think that this is something wrong? Correct? Because higher gross NPA would mean lower ratio. Hence, we'll put the correct solution here. Gross NPA the ratio should be 5:40. This is the ratio. Then this is the next part is what? Assigned weights. Then weighted ratios. Okay. Now what is the weight for this? 30%. And hence 30% multiplied by 5:40 becomes as 0.0375:1. Ideally, it is not 1, but it is for the 0.30 because we have multiplied it by 30%. Correct? Simple. Then capital adequacy ratio. Capital adequacy ratio, I'm just putting, first of all, I'm putting this into a box so that you all will remember that this is the point for which we will have to take the reverse numbers. Correct? Then capital adequacy ratio, higher it is, better it is, lower it is, worse it is. So 5/16 is the right number. 5:16, and it is 28%. So this becomes 0.0875 is to 0.28. See, student, just for the avoiding the confusion, I'm just writing the numerator part only. Ultimately, once we add all of them, it will be is to 1 only. Correct? Because all of you should not get confused. I've just put 5 divided by 40 into 30% comes as this much, 0.0375. Okay. Now the next part is market price per share. What is the market price per share that is given? 12 and 96, and 32 is the weight. 12 is to 96, 32% is the weight, and this comes as 0.04. Now the next part is book value per share. So the book value per share, first of all, we are not given the book value per share in the question directly. We will make use of the calculations first and then arrive at the ratio here. So calculation of book value per share. So weak bank is there. And there is a strong bank here, correct? So share capital. First of all, what is the share capital? 150 and 500. Plus reserves and surplus. 80 and 5,500. See the kind of reserves that strong bank is holding. 5,500 against only 500 of share capital. It's very strong bank. Minus preliminary expenses. Still there is a 50 that is to be written off. Hence, we have taken it in the valuation to arrive at the corrected balance. This is all in rupees lakhs. Okay. $180 and 6,000. Now the number of shares is also given in the question 15 lakh and 12 lakh. 15 lakh and 50 lakh. Hence the book value per share comes as 12 rupees here and 120 rupees here. So this is 180 by 15 and 6000 by 50. So this is what the book value comes out to be, and hence it is, the ratio will be 12 is to, oh sorry, this market price has not come, is it? 12 by 96. So this was 12 is to 96. Okay. Yeah, book value becomes as 12 is to 120 and the weight is 10%. Hence the total amount will be 0.01, and we have to just take a summation here, a normal summation. It comes as 0.1750 is to 1. This is the ratio. This is the ratio. 0.1750 is to 1. Sorry. This is basis whatever the question has asked us to do. It has asked us to assign some weights on gross NPA, on capital adequacy ratio, on market price and book value, and arrive at that what is the right value for the swap should be. Coming on to the next part, ascertain the number of shares to be issued to weak bank. Simple. We know the exchange ratio. We know that what are the current number of shares of weak bank. Correct? The current number of shares of weak bank is 150 divided by 10, which is 15 lakhs. So we can easily calculate number of shares to be issued. The second part, number of shares to be issued by strong bank to the shareholders of weak bank. Correct? Again, I'm just putting that it will be issued to the shareholders of weak bank, not to the weak bank itself. So 150 by 10, these are the total number of shares that weak bank currently have, multiplied by 0.1750 exchange ratio. This becomes 2.625 lakh shares. 2.625 lakhs shares. So 2,62,500 number of shares will be issued to the shareholders of the weak bank. And this will be issued at what price? At 10 rupees. Correct? Because in the books, the price per share is how much? 10 rupees. So for all accounting purposes, this will be accounted as 10 rupees as issued price. Now students, the third part now, correct? Prepare balance sheet after merger. Okay. So in this, students, we are not going to follow any other format apart from what it is given in the question. We will prepare it in the same manner. We will just put assets and liabilities, that's all. Okay. But before doing that balance sheet preparation, do we need to calculate one more thing? I'll tell you why it is required to be calculated. So first of all, what is the, see, if you see the two balance sheets, let's say this is the strong bank and this is the weak bank. So what will happen? All the assets and liabilities will come and get added as a horizontal summation. Simple. But what about the capital? Because strong bank is giving some consideration So hence strong bank needs to compare that value of consideration with what it is getting. And if it is at a higher value or at a lower value, the strong bank to adjust accordingly. For example, in this case, it is a basic thing which will be there in your paper number 1 as well. Okay, but I'm just discussing in this context, book value of weak bank, because the assets and liabilities would be taken over at the book value, because in the question it's nothing else that is specified. So how much it is? 180. This is the total book value. See, this 180 I'm putting. That means the assets and liabilities worth of 180 will be taken over by strong bank, correct? I think all of you agree with this. But what is that will come into the books of accounts as a payment consideration, less issue of shares. 2.625 lakhs shares are issued at rupees 10 each, correct? Because 10 is the 10 per share is the 10 per share is the paid up share capital per share. Hence, it becomes 26.25. This will get reduced from here, and hence the capital reserve will be how much? 180 minus 26.25. See, students, I am taking over the assets and liabilities of 180 lakhs, and I'm issuing the share capital of only 26.25 lakhs. Don't you think I am getting more and issuing less in terms of the valuation? I'm saying, hence there is a reserve that will accrue to me, that I will say it is a capital reserve, which will also be part of the balance sheet. Because student, if you see, I am adding 180 to my asset side. Simple. I'm adding 180 to my asset side and 26.25 to my equity side. Hence, 153.75 also needs to be balanced out in the form of a capital reserve, so that this represents that I have taken over something extra by paying lesser amount. So this becomes our reserve. Naveen Prakash is asking, are there any other adjustments to book value calculation like preliminary expenses? Yes, Naveen. So in this question also, we have seen that what is the correct book value, because already the preliminary expenses to be set off, remaining to be set off from the P&L is 50. The balance is 50. So that we have adjusted and seen, because this is just a fictitious assets, correct? This is not real asset. So similarly, like this, if there is something else, that also can be netted off. Okay, Naveen, for example, this deferred revenue or deferred expenditure on advertisement, if those are the things that can be set it off, whatever is the fictitious asset, that can be set it off from the book value. Okay, the capital reserve is 153.75. Now we can just simply prepare the balance sheet. So first of all, cash. Let's start with the assets. Cash in hand slash RBI. We will just do a total, simple total here. See, I will start from here, put all the assets till here, correct? So 400 plus 2500, 2900. Balance 2000. I'm just doing a simple horizontal total. Investment 20,100. Advances 30,500. Other assets 2,070. The total comes out to be 57,570. Coming to the liabilities side, equities and liabilities. This balance sheet is as on. We will put the date. This is the assets and this is the balance sheet. Rupees lakhs, correct? Paid up share capital. Now, paid up share capital already it was 500 lakhs, Additionally, we are issuing 26.25 lakhs. So this becomes 526.25. Correct? Because 26.25 is what is additionally issued. 2.625 number of shares multiplied by 10. Reserves and surplus is how much? Reserves and surplus will become, we will put only for the strong bank, not for the weak bank, correct? Because already for this 150 plus 80 put together, we have issued them the shares, correct? It's not only for 150, we have issued for 80 including in that, correct? So hence, we will only put 5,500. Then we will put capital reserve that we have calculated above, 153.75. Then there are deposits that the bank holds, 48,000, and other liabilities. 3390. The total is 57,570. This is the total. So this is the addition. I will just put it here with a red. What I'm taking is the horizontal addition. Simple. Correct. And the paid up share capital reserve surplus capital reserve is what is manually calculated basis whatever ratios that we have decided earlier. Now coming to the last part. Calculate the CAR and gross NPA of strong bank after merger. So students, this is also a very interesting part, correct? Because they are saying that they have given you both the individual values. Now you have to calculate the CAR and gross NPA for the combined bank. It's very simple. First of all, we will calculate whatever is the ratio basis that there are two elements. Both of them we will calculate and just add it up. Simple. So the D part. Calculation of CAR and gross NPA percentage. 1. Capital adequacy ratio. First of all, we know that capital adequacy ratio is total capital divided by risk weighted assets. Correct? This is what is given in the question also. And this we know as well. So we will put for all the banks, weak bank, strong bank, and merged bank. So weak bank, it is given as 5%. It is given as 16%. Merged is what we have to calculate, correct? I'm talking about the data that is given in the question, which is this 5 and 16 capital adequacy ratio. Okay. 5, 16 and merge we will calculate. Total capital is how much? Total capital is 180. 6,000 here. Correct? That is the total capital including the reserves and surplus. And for merged bank, we just now calculated. Merged bank, it is how much? 153.75 plus 5,500 plus 526.25. So it comes as 6180. So this is 526.25 plus 5,500 plus the Capital reserve 153.75. Simple. 6180 becomes the total capital. That means the risk weight assets is how much? 180 divided by 5%. 3600. Similarly, 6000 divided by 16%. 37,500. And the merged will be just an addition of both of them. 3600 plus 37,500, because the merger will not impact the respective risk weighted assets, that will remain same. So it becomes 41,100. Can we calculate the CAR? CAR is equal to 6, total capital of 6180 divided by 41,100. This gives us the CAR for the combined entity. 6180 divided by 41,100, 15.04%. This is the CAR. Combined entity, the CAR is 15.04%. So this is done. Then the gross NPA. Weak, strong, and merged. Correct. These three cases we will take. Gross NPA percentage is given as 0.40, 0.05. This is what we have to calculate for the merged bank. Correct. Advances. See, students, as I told you that NPA percentage is always on advances. Correct. So what are the advances as per their balance sheets? So 3,500 is the advance as per the weak balance sheets, and 27,000 is the advance as per the strong's balance sheet. So hence the gross NPA in absolute terms is coming out to be 3,500 multiplied by 0.40. Correct. That will give us the gross advances. 3,500 multiplied by 0.40. Similarly here, 27,000 multiplied by 0.05. This will give us the correct percentage. So the gross NPA becomes 1,400 here and 1,350 here. And the total of both of them, 1,400 plus 1,350, will be 2,750. And the total advances is what we have already taken in the balance sheet as well, 30,500. Correct. The gross NPA percentage for the merged entity will be 2,750 divided by 30,500 into 100, which is equivalent to 9.01%. So with this question is complete, and we are able to now have a overview, and we know the complete basics on mergers and acquisitions, even with respect to the different types of questions that we have done. Okay. Now, since we have completed almost all the things in the mergers and acquisitions and corporate restructuring, now we will move on to some of the theoretical concepts, and we'll see to understand them. Okay. So students, let me just start from here, and then we will build upon the new things. So in M&A, which is the mergers and acquisitions, if you see the entire topic, it is into two parts: mergers and acquisitions and corporate restructuring. Correct. So the corporate restructuring also we will cover now. Okay. Now, we started from M&A. We said that there are different types of cases of an M&A, where there is a merger, where there is a acquisition, where there is a demerger, or where there is a A plus B is forming as a C, which is the new entity. Okay. Then we studied that there is a purchase consideration that has to be calculated, which will be given by A to the B in the form of three things, either in the form of three things, any of the three things. One is they can issue equity shareholders to the shareholders of B Limited, or through the cash payment, or mix of B and 1. And this is the generic process that we studied. First of all, the valuation or the equity value has to be calculated for both A Limited and B Limited, then the swap ratio and the post-merger analysis as well. Then we studied that what are the different types of swap ratios that can be calculated. In this, now we will add one more part. So one was basis MPS, one was basis EPS, one was basis book value per share, and the last one, which I will write here, is basis the gross NPA. Gross NPA percentage of A Limited. A Limited is the acquiring bank, for example, and because that's what we are studying in this part of the section, gross NPA percentage of B Limited. B Limited I will put here as the target company, and A Limited I will put here as the acquiring company. Correct? This whole divided by this. So the idea here is that we want to highlight that in case of a negative ratio, the formula will swap. The numerator will become denominator and denominator will become numerator. Then there are other formulas that we studied, EPS. Then we studied that what is the effect on EPS post-merger through this slide. In this, the only retention point or only the main point to be remembered is that while seeing it for the target company, don't forget to adjust it for the swap ratio. Similarly, for the market price as well. See, swap ratio is what we are going to adjust. Simple. Now, students, so this is what it is. And then we studied all the questions. Now, let me go to the further part of the topic. Wait, I think just a second. Yeah. So now, students, if you see the mergers and acquisitions, okay, we have studied first of all what are the different types of mergers and acquisitions, correct, in the first part of the lecture. Now, what are the rationals? What is the reason behind a merger and acquisition? What is the rationale behind a merger and acquisition? So this we have studied in a lot of the question, that the first and the foremost is synergy. This I have explained in one of the question as well. So what do we say that synergy is? Synergy is because two companies come together, some of the inefficiencies in both the separate companies will go off, or some of the common cost, common overheads will not be there in the new company. Hence, we say that value of A and B, which is the merged entity put together, is higher than value of A plus standalone value of B. So these are the standalone values of A and B. This is the merged entity value. This value will be higher because of the synergy. For example, I had given you an example where two manufacturing plants come together. So for both of them, earlier were operating under two different companies. Now, since they were operating under two different companies, there were a lot of overhead related amounts. For example, the board of directors remuneration. For example, the supervisory layer. The supervisory layer means I'm saying the administration team, right? The office staff was all replicated in both the companies, but since both of them coming and joining together, they will not need two set of board of directors to run the double output, correct? So that will bring in some of the cost reductions. Similarly, now the capacity utilization will also be much to the greater extent. Hence, the level of output will increase. They will be able to produce more output with the same level of input, which will give definitely a lot of synergies. Correct. Then, so this is one that they will want to look the value beyond what they are acquiring. That is called as synergy because of the operating gains. Second part is diversification. Now, students, if you see that there are two different companies, A and B, both of them are into a very different industry, which is not related to each other. So A is in industry one and B is in industry two. Still they are merging. Still they are merging. For example, A is in FMCG industry, B is in real estate industry. Correct. But still both of them are merging. That means A is getting merged into B or B is getting merged into A, whatever it is. But this is why they are doing is to diversify. Both the businesses will remain in the new company, but they want to diversify. They want to reduce their risk. Now, students, if you remember from the earlier sessions on portfolio management, we said that diversification is possible. Correct. Diversification will reduce the overall risk. That is what they are wanting to do. They want to diversify in their portfolios. So basically, FMCG company wants to expand and enter into real estate, and hence they are acquiring B Limited. So that will diversify and hence reduce the overall risk, reduce the unsystematic risk, correct? Because unsystematic risk is basically specific to a company. Systematic risk was overall related to the market, correct? Then third part is taxation. Now, so students, please see that we are discussing the rationales. Why there is a need or what is the rationale behind these M&As, correct? One is synergy, second is diversification, third is taxation. Now, what happens? Whatever we have studied in the form of questions also till now, we have studied that there is a weak company and there is a strong company. So strong company takes over the weak company, correct? And hence the weak company, since there are losses, that means because of those losses, there are some unadjusted tax losses also, which can be carried forward and set off. So what strong company will do after merging, it will also get an access to these unadjusted tax losses to be set off against the future profits. Of course, within the overall scheme, within the overall regulatory framework, because the taxation laws also specifies under what conditions it can be carried forward and set off. Correct. So keeping all of those things in mind, the strong company will acquire weak company to adjust those unadjusted tax losses, because weak company is not going to have future profitability, definitely. So they will use that to set it off against their own future taxable profits. Correct. Then, so this is another part. This is another rationale why strong company would want weak company to merge with itself, so that it can make use of the unadjusted tax losses and set it off against the strong company's profit so as to avoid taxation. Correct. But again, I'm saying this will be within the regulatory framework. There are a lot of rules, regulations, acts, sections on this to avoid any leakages. Correct. Then fourth part is growth. Now, students, if you see how it can lead to growth. Now, there are two companies, A Limited, B Limited. If you see, A Limited is growing year by year at the rate of 10%. For example, their revenue is 1,000 crores. This I'm talking about year one. In year two, this became 1,100 crores. Correct. And A Limited is into again the FMCG business. Again, I'm assuming it. And B Limited is also in FMCG business. Okay, both of them are into the same line. Now, the year-on-year growth reported for A Limited is 10%, correct? 100, so 1,000, 1,100 divided by 1,000 will become 10%. Now, what if they want to grow inorganically? So this is called as organic growth. Organic growth. There is a term called inorganic growth. Inorganic growth means that now there is a separate company called B Limited that is already having a 600 crore worth of turnover or the revenue. I'm saying the overall revenue is 600 crores. I'm not talking about the bottom line as of now. So what A Limited says that, okay, if I take over B Limited, okay, if I merge B Limited, this revenue will also come and the overall growth will be higher. So what it will think is from 1000 crore, it will go to 1700 crores. In this, we can say 10% is organic growth. So there is a total 70% growth, right? There is a total 70% growth. 1700 divided by 1000 is equal to 170%. 170% minus 1 gives you the growth of 70%. So 10% out of this will be organic growth and 60% out of this will be inorganic growth. But still they are able to show 70% kind of a growth. So the growth is another rationale for the mergers because it will increase the growth percentage. It will increase the inorganic growth. Okay, although it will be properly classified in the financials as well as in the annual report of the company that this much is coming from the inorganic growth and this much is coming from the organic growth. But inorganic growth will also lead to some of the valuation advantages, correct? Now, so this was the fourth part. Growth was the fourth part. Then fifth part is consolidation of production capacities and increasing market power. Consolidation of, this is purely from the study material only, students. Okay, so don't, you just keep these concepts in mind and keep on noting the pointers here. The exact language, please refer to the study material. Okay, the idea here is to make you understand what is behind those concepts. Now, consolidation of production capacities and increasing market power. This is again very similar to what we have already studied. For example, there are two companies, A Limited and B Limited. Both of them are operating into different production capacities, into different production plants. Once we merge them, both the plants come together. I mean, both the plants are now under part of the one company, which is A Limited. So that is called as consolidation of production capacities. And similarly, increasing market power means, for example, A Limited currently is having 60% market share in the industry in which A Limited and B Limited, both of them operates. And B Limited have a market share of 10%. Now, A Limited is of the view that if it acquires B Limited, it will have a dominant position. Although currently also it is having a dominant position, but still B Limited is also having a good share. Because apart from that, 30% is owned by, let's say, thousands of small players. 1000 players, small players, correct? So A Limited will increase the market power by merging B Limited into itself and having a total share of 70%. So this is another rationale for the mergers and acquisition. Okay, students. So these are some of the rationales why companies would look into for the mergers and acquisition. Now, coming to the different types and forms of mergers and acquisitions. So first of all, students, the first and the foremost part is horizontal merger. Now, what does an horizontal merger means? See, what is first of all a market, or what is first of all called as an industry? Industry is actually a collection of companies that serves a common set of consumers. Simple. So there is a common set of consumers with a common need, correct? Their need is also common, with a common need. For example, automobile industry, correct? Automobile industry they will give consumers four-wheelers, correct? Cars, two-wheelers, all those things. So that is called as an industry. Automobile industry is one industry in which there will be 10, 15, 20 players, different players that are there. Now, both A Limited and B Limited are into the automobile industry. Both of them are into the same industry. Both of them manufactures four-wheelers, these vehicles such as cars and other things, and sell it to the consumers. So that means both of them, if they both of them merges, that is called as horizontal merger, because both of them are at the same level. Both A Limited and B Limited are at the same level in the industry in which they operate. By same level, I don't mean that they enjoy the same level of financials as well. I mean, A Limited would be a strong company, B Limited would be a less strong company, and hence, just a second, students. Yeah. So I'm saying that both of them are at the same level in the industry, and hence we are saying that this is a horizontal merger. At the same level, the merger is happening. That means there is some kind of an industry consolidation that is happening. Simple. Second type is actually vertical merger. Now, this A Limited is a company and it supplies to the customers. Correct? It supplies to the customers and it takes some kind of supplies from the back-end suppliers. Correct? Whatever are the raw materials and packing materials, it will take from the suppliers and do the processing and then will provide the finished goods to the customer. Now, if you see this supplier, for example, is B Limited in this case, which supplies the raw material, packing material, RMPM to A Limited. So the combination of A Limited and B Limited will result into the vertical merger. The merger of B Limited with A Limited will become the vertical merger. Why? Because they are enjoying the buyer-seller relationship. Wherever there is a buyer and seller relationship and that gets merged, that is called as vertical merger. So I have drawn this as a chain, right? So B Limited supplies to A Limited supplies to customer, like that. And in case of horizontal merger, it is from the same industry. Simple. Okay, students, I hope this is clear to all of you. Again, students, if you have any questions, please ask so as to make this more interesting and contribute with your thoughts as well in the entire discussion. Yes, now the third part, conglomerate mergers. Now, what does a conglomerate merger means? Conglomerate mergers, again, I'm taking the A Limited and B Limited are the two companies. Both of them are unrelated. Both of them are not related to any sense. Again, for the diversification, I said FMCG and real estate. Correct. Both of them are merging. This is not even horizontal, not even vertical. This is some other kind of a merger. Conglomerate means it is a group of diversified business. Correct. So they are diversifying, and hence the same thing I used in the diversification as well. Correct. And there are no important common factors. There are no important common factors such as suppliers, common factors such as industry, common factors such as the consumers to whom they target, common factors such as brands, correct, common factors such as products. There is no commonality between both of them, and hence it is called as conglomerate merger. Correct. This is to make sure that different types of businesses comes under one company, comes under one flagship company. That is called as conglomerate merger. Fourth part, co-generic merger. Now, this is very important. This is very important. Now, what happens in co-generic merger? Definitely, it's not a horizontal merger, it's not a vertical merger, and it's not even a conglomerate merger. Correct. Now, what is the uniqueness to this co-generic merger? So, students, if you see what is a co-generic merger will have, again, I am taking A limited and B limited. Both of them are not the competitors exactly. Both of them, but do operate in the same industry. So they both of them operate in same industry, or they have something in common. Some factors are common. What are those factors? For example, they might be using the same kind of technology. They are using the same technology. Although they are not competitors to each other, they are not serving the same consumer set, but still they are using the same technique. Or they are actually using the same distribution channel to distribute their products, to sell their products. They are using the same distribution channel, or they are having the same market participants, or there is something common in the products also. Product line is common. Now, to give you an example, okay, don't get confused with all this. Just remember this one very good example on co-generic merger. This A limited is a NBFC which have a business of giving auto loans. So this A limited is a NBFC which gives loans only on auto loans. Only for the purpose of purchase of 4-wheelers, 2-wheelers, they will give the loan to the customers. That is their main business. Now B limited is again an NBFC, but they have a business to issue credit cards. Or I am saying, let's say they are into the personal financing, because credit card is also one form of personal financing, correct? Because it will help you to meet out your personal expenses. That is why credit cards are issued. Now, if you see, students, is A limited and B limited, first of all, are operating as a competitor to each other? No. Why? Because both of them are targeting a very different consumer set. A limited is targeting a consumer set who needs a auto loan. B limited is targeting those consumer set who needs the personal finance. Because using credit card, you cannot go and purchase a vehicle. Correct? For that, you need to go for a auto loan only. So hence, both the consumers are different. They are serving different consumer sets. But what is the common thing between both of them? Number one, they are into the same industry. Why? Because both of them are actually into the industry of lending the money, correct? Giving loans, industry of giving loans. In other words, both of them are NBFC, non-banking financial corporations, correct? So that thing is common to both of them. Plus, second thing which is common is that the way they target their customers, their channeling, they have brokers, they have, let's say, some distribution partners, they have some agents who will bring the business, correct? So the channel through which they access the customers is common, through which they access the customer is common. Third thing, I mean, if they go through agents, both of them will go through agents for their loans. both of them will have their representatives who will sell their loans. Similarly, the first, second, and third. Now, the third part is what I'm trying to say. Even the product line, there is a commonality attached to it. That first there is a loan, then there is an interest, and then there is a repayment, and lastly there is a security. Correct. So the product features are common, except for the fact that what is the purpose of loan? That's the only what is the purpose of loan? That is the only exception. This is the only exception. Correct. So hence, according to me, both this A limited and B limited, if they merge together, it is neither called as horizontal merger. It is neither called as vertical merger. It will also not be called as conglomerate merger. This will be called as co-generic merger. I hope the co-generic merger definition or the term is clear to all of you. The next part is reverse merger. The next type of merger is reverse merger. As of now, reverse merger I will take up in detail in the next part. Correct. So hence I am skipping it as of now. I will take it in just 5-10 minutes after this. Okay. Reverse merger is a separate thing that I will take up. Then the last part is acquisition. Now, what is acquisition? Acquisition is just simply acquiring a majority stake. Acquiring the other company. Now, how that other company can be acquired? Number one, by purchasing shares, purchasing majority shares. Correct. Or getting into the agreement which gives them the right to control the management. So basically, board of directors, they will represent themselves. So there is an agreement. Correct. That also will mean that they have acquired. They will go and purchase the shares in open market or through an agreement. Correct. Through any other means, they are going to acquire the company. Simple. So acquisition is very simple to be understood. There is nothing else there. Now let me go to the next part. Now students, now coming to the next part. So we have studied that what is the rationale for an M&A, what are the different types of mergers and acquisitions. Now comes the next part, that what is the scheme of amalgamation or merger. There is a scheme that is prepared that you will be studying in your law examination, law paper, in which there is a proper scheme that is made. There is a effective date. Effective date means the date from which that merger will come into force. And definitely it will talk about the valuation of shares, because that also is a key thing. Correct. So there is a scheme that is prepared, that is approved by the high courts, that is approved by the lot of authorities, that is given as a part of the regulatory requirement. Yeah. Now let me go to the reverse merger. Reverse merger is actually separately also given in the part of the curriculum. Now students, please pay all your attention, because this is a very different type of thing from what we have studied till now. Now students, generally we have seen that large companies take over. Either I am using the word takeover, or I can say that the small companies merges into the large company. Correct. Merges into the large company. That's how it happens. But in reverse merger, we take a case where a private limited company and there is a public limited company. So public limited company will get merged into private limited company. So there is a reverse merger that is happening. So private limited is generally a smaller company. This public limited company is actually a larger company. So the larger company gets merged into the smaller company. Now, why it is being done? First of all, this public limited company is a shell company. By shell company, we mean that currently it has a lot of accumulated losses. Okay. It is not doing any proper business now, no operating business currently. And this is totally a shell company. I mean, this is a sick unit which is not viable to be continued. This public limited company, correct? Now, we call it as a reverse merger. Now, what is the process? How it happens? Since it is a shell company with no operating margins, with almost all the losses that it have, so what will happen is this private limited company will talk to the public limited company's shareholders. So both their company's shareholders will swap their shares. So there is a shareholder of private limited company. These are the shareholders of public limited companies. For example, I'm saying these are group A. For example, A is the group I'm giving to the name of the shareholders, and B is here. So now what A will negotiate with B is that A will get a majority stake in public limited company. That means private limited owners are buying the public limited company. And once it is taken as a majority stake, what A will tell to the shareholders of the public company is that, okay, in return, we will give you some of the shares of the private company. So we will swap the shares, but in such a manner that because this public company is in losses, so they will swap to their own advantage. So this private company shareholders will swap to their own advantage. And once they are holding the public limited shares, already the private limited company shares are converted into the public shares. So that means this private company is able to go public because those shares can be sold in the open market, which the shareholders have. And hence, it is one form of going public. So this has helped the private limited company to go as public. Correct, because they will hold the public limited shares now, and the public limited will be merged here. Okay, that is why it is called as a reverse merger. Okay. So hence we say that in case of a reverse merger, the smaller company takes into account and the bigger company gets merged into the smaller company. Mostly it is private and public companies. The reason behind doing that is that a private limited company wants to go as public, but they don't want to go through the route of proper IPO process because that will involve a lot of cost, that will involve a lot of time. So they will follow this route where they will swap their shares with the shareholders of the public company, and they will get the majority shares of the public company, and which can be easily sold in the market. That is called as reverse merger. Okay. Now Siddharth is saying that a good question from Siddharth. He's asking, sir, how it differs from conglomerate. I think Siddharth, you would be asking for the co-generic merger, if I'm not wrong. So if I go back to the previous discussion, just a second. Yeah, we discussed from horizontal, vertical, conglomerate, and co-generic. So Siddharth is asking, sir, how it differs from conglomerate. Food Panda was acquired by Ola, then it is conglomerate or co-generic. Good question. Actually, Siddharth, just reading out at least these two things, we need further facts to evaluate this. But whatever is the difference between conglomerate and co-generic is very clear to us. One is conglomerate means that both of them operate into the very different industry. There is no linkage at all. There are no common suppliers. There is no common technology. There is no common product lines. There is no common channel at all. Both of them operate into a very different companies, and both of them are having a very diversified portfolio. Correct. Now, co-generic means at least they have something in common. Correct. Now, what is that commonality? As I told that both of them are NBFCs and both of them are into the business of lending. Now, if we see for Food Panda and Ola, that means both of them were at least into the different industry altogether, because Ola was giving whatever their services on the transportation, and Food Panda was related to a food services. Correct. But if you see, there would be some kind of commonalities. Both of them, you would be using a common kind of a platform, or both of them would be using a common kind of technology. Correct. So if you see from that angle, that will become a co-generic merger. Correct, because it is just an extension of the same product line. Correct. So it would be difficult for me to say, Siddharth, whether it is co-generic or it is a conglomerate merger without going into the proper facts. Hence, I'm saying it's better for us to understand the difference between both of them. Conglomerate is totally different, unrelated industries, companies. If they come together and merge, that is conglomerate. And co-generic, if there is some kind of commonalities. I still feel that this would be a co-generic, but I would resist myself to comment on this. Okay. But I hope the difference is clear in both of them between co-generic and conglomerate. Okay. Because we would need additional facts and data, and we would need exactly what are the details to comment upon whether it is this thing. Okay, Siddharth. Yes. To some extent, we can assume that. Because both of them are, let's say, operating on a aggregator model. Both of them are aggregating the vendors and the customers, Food Panda as well as Ola. Then at least there is some kind of commonality, and there is some kind of a common platform or technology that they're using. Okay. Now coming back, I think the reverse merger is clear. The reverse merger is generally the public company acquires the private company, but in this case, the private company is getting the majority stake into the public company, and public company is getting merged into the private company. As a result, the shareholders of the private company are getting issued the stake in the public limited company, which will help them to go public, which will help the private company to go public. Okay. Now there are some conditions attached to it. What are those conditions? For a merger to classify as a reverse merger, there are three conditions has to be satisfied. Number one, the assets of the transferor company are greater than the transferee company. Now, private limited, this is transferee, and public limited is transferor. So this public limited assets should be higher than the private limited assets. Correct? That is the first test. That is when we will say that a small company is eating up the big company. Correct? Because the company will be big if its asset side is big. So we will say that the private limited is actually acquiring public company once public company is bigger. That is why it is called as a reverse merger. Second, the equity capital to be issued by the transferee company pursuant to the acquisition exceeds its original issued capital. That means, let's say, it was having 100 crores of, not 100 crores, that's a very big number to assume. For a private company, I'm assuming, let's say it has a 5 lakh worth of equity share capital. And after the merger, the private limited issues its equity shares to the public limited shareholders, and this becomes as 15 lakhs. Then only we will say that there is a reverse merger that has happened, because private limited has ended up issuing more equity shares compared to what it was having earlier, from 15 lakhs to 5 lakhs. So it has issued further 10 lakhs. Correct. So that means it is acquiring a bigger company than itself. That is why it is issuing higher number of shares. You're getting my point. Then the third part, the change of control in the transferee company through the introduction of a minority holder or group of holders. So they are saying that the third part is the change of control in the transferee company through the introduction of minority holders or group of holders. For example, now whatever majority stake is held by the private limited, there will still be a minority holders leaving here. So that should bring out that now there is a minority group left. The private limited holders becomes the majority shareholders. Then only it will make sure that the public limited company is merging into the private limited company, and hence it is called as a reverse merger. Students, again, I want to reiterate that this reverse merger is a very big concept, okay? And it's not, for us, it is at a very basic level to understand that the smaller company is taking over the bigger company. And what are the ABCs of those takeovers? That's all, okay? We will cover only the basic part. Now the reverse merger is done. Now coming to the divestiture. There is another term now called as divestiture. Now what is this divestiture? So divestiture means that there is a selling. So basically, ultimately merging means that we are purchasing, we are taking over, we are getting the assets and liabilities. Divestiture means we are selling assets, class of assets, business, or let's say a business unit or anything. I mean, we are just separating something from ourselves so that we can pay attention to the core business. So that, and what is the purpose here? Pay attention to the core business. Once we determine that for paying attention to the core business, we need to sell something, that is called as divestiture. Now, there are different forms of divestiture. One is sell off, or we can say this is also called as partial sell off. What does this mean? So sell off or partial sell off means that we are selling off. We are simply getting rid of some of the assets or some of the business units or some of the subsidiaries also, for that matter. We are selling it off and we are realizing cash. Simple. Second one is called as spin-off. Spin-off means that we are transferring the existing asset, subsidiary, or some business unit to a new company, and that new company will assign some of the shares to the existing shareholders. That means we are not selling it off. We are just separating some of the business to form a new company, and that new company will issue shares to the existing shareholders so that their overall value remains same. So they will be getting shares in new company, and this new company will be interested with some of the business. Correct? That is called a spin-off. We are spinning it off, some of the business. Now, next part, split up. Split up means that there is an existing business called A. It has 4 different units, 1, 2, 3, 4. What is going to happen is we are splitting up all the different units into different companies, and A will get dissolved. Split up means we are just splitting up all the different types of business divisions into different types of companies, and the ultimate company is getting dissolved. That is called as split up. And the last part is called as equity carve outs. Now, what does this equity carve outs means? So equity carve outs are those situations in which there is a spin-off that has happened, correct? But in spin-off, what we studied, that existing shareholders will get the equity in the new company. Apart from that, spin-off plus, I'm saying exactly same as spin-off plus, they will issue new equity shares in the market. Equity shares also in the market to raise the funds. That is why it is called as equity carve out. Apart from the spin-off, we are issuing new equity shares as well in the market. Then there is a demerger or division of the family managed business. The last part is actually demerger, division of family managed business. So this will also mean that since a business families have different types of businesses under their flagship, but they want to concentrate on some specific business, so they will demerge the other businesses from their main business. Yeah, now comes the next part, the second last part of M&A, which is the financial restructuring. So students, let us first understand why there is a need of financial restructuring. Now imagine a company which is a sick company. Okay. Why it is a sick company? Because the financials shows that there are losses in the current year. There are accumulated losses which are higher than even the share capital also. That means it has a negative net worth. This will indicate that the company is sick, that the company will not be able to revive, and there is no future plan also which can help the company to revive. Correct. Now, in this case, there is a plan that is actually implemented called as financial restructuring. Now, what does the financial restructuring means? Now, I'll tell you. I'll give you some examples that will help us to understand that there is a financial restructuring. Now, in financial restructuring, there are some professionals who are appointed who will go through the financials, who will go through the current condition, who will see that what is the potential, and then they will propose certain things. Now, what will be that proposal is called as restructuring only. Now, first and foremost thing in that proposal will be that all the people will forego some of the money. For example, equity share holders will forego their 5 rupees per share. So, for example, from 10 paid up, it will become 5 paid up now. Simple, 5 rupees gone. Second, the people who have given loan, their loan will be, let's say, was existing at 10%. So it will be restructured to 9% so that the future cost is lesser. Similarly, vendors will also be approached. We will tell vendors that 25% of your total claim is lost. We will not be settling 25%. We will settle 75% in 4 balance installments. Okay, so all these things will give additional cash flows and additional things to be managed, which will help the business to revive. Similarly, debtors. So debtors also, there is some bad debts that we will write off. Correct. To reduce the valuation of debtors. So this is all called as financial restructuring. Some of the loan, we will tell them to convert into equity, so that there is no obligation to repay the amount in future. There is a cash flow saving in that case. All these juggleries that is done, and to avoid, so as to make sure that the P&L and balance sheet becomes healthy over a period of time with the practical possibilities, is called as financial restructuring. Now, the next part. The next part is, actually there are 2-3 terms that I want to discuss. There is a term called ownership restructuring. Yes. Ownership restructuring. There are 3 things in this that what we are going to study. One is going private. There is already an existing public company. but it feels that there is no sense in being public, because being public involves a lot of cost of compliances, cost of whatever the new regulations keeps on coming, they have to comply with that. And on the other hand, it is not making any sense for them to be public. So what they will go, they will turn to private. From public, they will get themselves converted into private. How? By buying back their own shares. They will do buyback of own shares from market. This will reduce the equity share capital. This will reduce the equity share capital, and now the equity share will be closely held with some individuals and they can easily go private from public. Then there is a second term called as management buyouts. What does this term called management buyouts means? That the management itself of the company will take over the company, will purchase the company or take over the company, whatever it is. They will have now the majority share in the company. That is called as management buyout. When the management of the company itself buys out the company. Correct. This will help useful. Why? Because that there are certain divisions that do not form part of the core business strategy of the entity that can be taken over by the management. Correct. Then leveraged buyouts, LBOs. Leveraged buyout means that if there is a merger that is going to happen, that means there is a purchase consideration has to be paid. Correct? Now, if this purchase consideration is getting paid in cash, that means the entity who is paying it needs to arrange for the finance. Now, if the finance is coming from within, I mean, there is no need to go and borrow. That is okay. But if the finance is coming from a borrowing, it is called as leveraged buyout, because we have borrowed the amount and then we have paid the purchase consideration and we have taken the merger or we have done the buyout. That is called as leverage buyout, LBOs. Okay. That means we are not using the own money because we don't have, we are doing the leverage buyout. And the last one is equity buyback. Actually, there are 4 points. The last point is equity buyback here, which we already discussed actually, which is also linked to this going private. So going private, you can say that this is actually part of the equity buyback, and going private means converting the public company into the private company. Simple. Then I am now coming to the very last part, which is special purpose acquisition companies. Now let us spend some 10-15 minutes on this because this is a very new concept and very important as well from the understanding point of view. Now students, now these are very new type of companies that are emerging in the market. Now understand how does these kind of companies work. So first of all, I hope all of you are aware that there is a term called IPO, which is called as initial public offer. Initial public offer, which is basically to raise the funds from public. Correct? Raise the funds from public at large. Just a second. Just checking for the queries if we have got. Yeah. No. So yeah. So I'm saying that SPAC, the special purpose acquisition companies, are basically the entire premise is based on an IPO, which is initial public offer, and it is for the raising the funds from the public at large. This involves a lot of cost and a lot of compliance. You have to do the book building process, file the prospectus, red herring prospectus, do a lot of filings, and then you will have to witness the entire procedure. In recent times, also, a lot of companies have issued their IPOs. Correct. That means they're going public from the private. Now, what is the role of these special purpose acquisition companies? What they do is SPAC is a company that will launch a IPO. They will launch a IPO. Now, while launching an IPO, students, you would know that while launching an IPO, prospectus has to be filed in which it has to be very specifically called out that what is the end result of the money that is going to be raised. What is the purpose of raising the money? Correct. So, for example, if a company called ABC Limited, who is into the manufacturing business, is raising IPO, it will simply say that I will use that money for setting up a manufacturing facility or expanding the existing capacity. But in case of SPAC, they will not have any agenda as of now. What they will say is that as on date, we are raising the money. We will build a kitty. We will build a fund out of it. And we will form a trust in which all the funds will be kept, or we will put it into a escrow kind of escrow account. Okay, in that the funds will be held after launching an IPO and putting all the funds there. Then we will take some 2 to 3 years to evaluate and study different types of companies. And we will see that which company to be acquired. Which company to be acquired. That we will try to see from the deal. If we get an answer, we will go ahead with the deal and do that merger or that acquisition, whatever it is. After getting the proper due diligence and everything, that is what their main objective is. So, as of now, the biggest, I can say, asset in the market is certainty. Certainty of the future available data. If the market is uncertain, everyone will withdraw the money. Correct, because there is a higher risk. But the people who invest in SPAC, they are the people who want higher reward because they are entering into a highly risky proposition, because they don't know where the SPAC is going to invest. Because what SPAC currently have to sell it to the retail investors is that they will say that in future we are going to enter into some kind of a deal which will give us very good amount of returns. Now, there are proper regulations that has to be put here. There has to be a proper guardrail for this, in which the entire scheme has to operate. So some of them are, for example, there are some kind of SPACs that are operating, maybe not in India, but in outside countries. What they say is that before they finalize a deal, before finalizing a deal, now this is all to protect the investors' interest, correct? Because ultimately the investors' interest has to be protected. So before finalizing a deal, they will need a approval from majority shareholders. Approval from majority shareholders. This is one type of a guardrail that will help. If majority of the shareholders of this SPAC company agree to that deal, which is going to happen in after 2-3 years, then it is a good enough ground for the SPAC to go ahead and do the deal. Second type of guardrail is that till the time the deal is finalized, money is kept safely, correct? Money is kept safely, let's say in the form of a trust, or I can say in the form of a escrow account, correct? And the SPAC company will give an option to the investor what option they will give? That if you like the deal, okay, you go ahead and give your approval, we will invest. If you don't like the deal, we will return your money back. Okay. I mean, this is also one kind of guardrail, or this is also one kind of, I can say, the product that SPACs are offering currently to the retail investors. Correct. So they will say that upon finalization of a deal, if you are interested, then okay. If you're not interested, we will pay you back the money. Now, these type of companies, okay, let me just put one more type here, which is the third guardrail, or the third rules or regulations will be that there has to be a proper due diligence before a deal is finalized. Correct. Proper independent due diligence, which is actually the case for normal mergers and acquisitions also. Correct. So I'm just trying to discuss what are the different types of, I can say, the controls should be there while doing this SPAC, because this is a very highly risky thing. The other name of this SPAC is called as blank check companies. Why we call them as a blank check companies? Because the investors are issuing the checks in the blank name. Why? Because they don't know that for which purpose these things will be used. Okay. So let me just see if I have not missed anything. So this will make sure that the entire fundraising is process is very faster, in such a manner that they will be able to raise the money. Yeah, so I think mostly I've covered. But in India, this is still picking up, but it is getting a good pace in the outside countries in the form of contributions that they're getting. So this is all from my end. Now I will request CA Ashish sir, who is there with us, to express his thoughts and the concluding remarks. Thank you, sir.
Thanks a lot, Divas. Your session was very encouraging. Can you switch off the your iPad? Yeah, okay.
Yes, sir.
Yes.
Yes, sir. Yes, sir.
And your session, especially in the end, when you have covered the topic, theoretical aspect of this merger acquisition. Student, please note this topic. The end session was very important because the topic is your strategic financial management. Okay, and merger acquisition is one of the very important strategic. The merger acquisition is important from strategic angle. So theoretical discussion in the end was very, you can say, it was a key point. And even in the last, when you have covered this fact about this fact, this is a contemporary topic, and it is a future. I will say, just like whenever we say that, like artificial intelligence is future, ESG is the future, is one of the future aspect also, because now it will be sooner or later it will gain the pace in the India itself, because we are basically, whatever we are driving from the Western world. So
Yes.
of course it is also it will come to the. Now, one thing very interested seek my interest. That one point was like in the beginning when we were talking about the merger acquisition. So we say synergy benefit 1+1 is equal to 3. Okay, and when Divas was discussing theory, there was one term was conglomerate. Okay, when the two unidentical companies are joined together and to form a one merger, of course, student, this will give the value to the company, synergy benefit. But sometimes what happens when if a company is joining any new non-identical business, they can also suffer from the conglomerate discount also. Because what happens if you are entering into a company where you don't have any experience, of course, you have to be dependent on outsiders. Okay, so it may you have to face the problem, and that's why the concept of this spin-off equity carve out has started generating. Okay, so as the concept of merger acquisition important, equally important is this concept of divestitures. Now, in this, when I was reading newspaper, right, something where around in July 2021, it was a news in the, if you are aware that there's a company GlaxoSmithKline became. So this company has demerged their consumer healthcare division, and it is likely to be up by July 22. So their main motive was that because they want to concentrate on the drugs for other pharmaceutical products and consumer healthcare they are separating. So this was one major demerger we can say in the 2021. Now recently in just about 1 or 2 days, I think it will be around 13th January, I have read in the newspaper in Economic Times. There is a company, Motherson Summi Limited. They have also decided that they will, because they are in the basically they are in the manufacturing of the automotive components, as well they are in the wiring business, wiring manufacturing. So what they are doing, they are separating their wiring business. And as per Economics Time article, what they will do, they will issue the share into 1:1 in the as well as parent company, and in the one share in the new company that will be formed and will be called Motherson Summi Wiring India Limited. So, and they have fixed up the record date, 17th January, that is today's date. So any shareholder who is having their name in the register as on date, they will get the 2 shares. They will come. And when this news has come, the share has risen in the market, and there was an increase in the prices. Because so you can see not only there is impact on the price of the merger because price increase due to the news of merger, but there is a price change due to the merger news of demerger also. Because as per Economic Times, they said that there will be a value creation of 5% in both companies. So we can say that if the merger and acquisition gives the synergy benefit, so demerger also creates the value creation. So it is one of the important aspects also, and we have to keep this in mind. So I hope the today's session, the topic of merger acquisition has come to an end. Students, there is one topic has been left, that is startup finance. So of course, the startup finance is basically a theory topic, and we expect that there you should can go through yourself. But as we have requested the Divas, at least just in the next class, take some half an hour session on the same. He will cover briefly the session on topic only. Then thereafter, there was one topic left, that is value at risk, when we were doing the risk management topic. So Divas will take up this session, and in the end, I will take up the final session on how to face, on how to crack C examination. So student, my request to you all, please do attend the next session, and we will take up your all queries also. And Divas, can you just share your email, your iPad, so that I can just get them taken?
Yes, sir.
As usual, our email ID is sfm-final @ICI.in, and my contact number is 0120 3045 956. Students, although I am receiving the mails from you, but what happens, sometimes student does not mention their name, their registration number, and even phone number. Student, please don't worry. We are here to help you. I don't know what is their rumor about this, that please don't share your email ID. There is nothing to worry about. We want to connect with you, and we want to sort it out your all queries. So sometimes even what happens from the mail, first of all, if you want to ask some more points, and for drafting the mail, you spend half an hour. So my request to you, please don't spend your time, precious time in writing the mails and rewriting the emails. Sir will things like that. You just give me a call on the phone, or otherwise, whatever mail you write me, please do mention your registration number and telephone number also. If I could not get the understand your query, then I will revert back to you over your telephone. Student, please be in touch with us We are here to help you out. We don't, you not to worry anything about the same, because sometimes there may be some rumor they will do like that. Nothing is there. We are student. We are here to help you. Okay, Devas, thanks a lot for your
Thank you,
precious
sir.
time, sparing precious time, and throwing the light on this complicated topic. And
Yes,
we
thank
shall
you.
see you in the next class with a startup finance. Okay,
Thank you, sir.
students, have a nice day. Okay,
Thank you,
Devas,
sir.
have
Have
a
a
nice
nice
day.
day. Thank you, sir. Thank you.